Hey, good morning, everybody. It is Saturday morning and time for Multifamily Unplugged. I hope you're doing well. Had a great week. Let's give some people a few minutes to log on here. We're going to do something a little bit different here this morning. Today, we're going to do a live Q&A, and I have a list of questions that people have sent in or asked over the last few weeks about multifamily and about multifamily investing. And I want to try and go through that list a little bit and see if we can't get some questions answered. If you have questions and you're listening in this morning, drop them in the comments. I will definitely get into the comments, try and answer some of those questions today and see how we can get maybe some interesting questions that you have addressed. Hey, remember, let's talk about intentions, okay? We talk about intentions, or I talk about intentions a lot. I name my company My Core Intentions because I think that we need to be intentional about everything that we're doing in our life. So are we being intentional about our work, about our workflow, how we're prospecting? You know, I just had a coaching call this morning with a client, and we were talking about sales. We were talking about how to increase the sales in his business. And he owns a staging company, and it's an ancillary business for the real estate business. It's a local based business, a little bit more local than we can be in the multifamily space. But we talked about prospecting. We talked about sales. How do we increase sales? What can we do a little bit more? And I'm so focused on prospecting, picking up the phone, making those outbound phone calls. It's different than just marketing or doing social media marketing or putting posts out there, but it is talking to people and asking for the sale, and it's all in the numbers when we do that. He has a goal of making 200 calls a week, right? And I remember when I was selling residential real estate, I would make 100 calls a day. And those 100 calls a day ultimately resulted in 20,000 a year. And I knew, though, from those 20,000 calls a year that I would sell 125 listings a year. So, but I was intentional every day. I was intentional about starting my business. The other conversation that I've had around this intentionality this past week has been around scheduling and time blocking. We can build a schedule and we can build a plan for our business and a direction that we want to take our business in, but not only building that plan, but we have to execute, because execution is really important. So here's the conversation I had with another coaching client this week. It was, build your plan, time block, okay? That you need 2 hours every morning to prospect. You need 2 hours every day to underwrite your multifamily deals, to analyze those new deals. You need 2 hours every day to be building relationships with brokers and lenders and the ancillary people that help add to your business. If you block that in, it's great and your schedule looks great. And then you build in time for appointments or doing other, office activities and things like that to keep your business running. But here's what it comes down to. You've got to show up for the appointment. Hey, if you had a listing appointment, you'd show up for that. If you had an appointment to go look at a building that's for sale, you'd show up for that. If you were underwriting a deal and you had an appointment with a lender, you'd show up for that. So when we time block, we have to be intentional. It's all in the intentionality about showing up. So I want to talk a lot more about this. I have a ton of questions that people have sent in. Like I said, if you're just tuning in this morning, good to see you. Throw your name in the chat, say where you're from. I'd love to hear from you this morning. I'm doing a live Q&A. I've got a number of questions that people have been asking over the last several weeks and months, and I want to get some of those questions addressed and talked about here this morning. So if you have questions, put those in the chat. We'll try and get those. Good to see people this morning. I'm glad that you're here. Remember, in October 20th through the 22nd, the Multifamily Summit is coming up. I'm hosting a 3-day virtual event. We're going to have 20 speakers from around the country on the main stage. I'm going to have a breakout room with 3 panels going on. So another a dozen speakers, over 30 speakers at this event this year. We're also going to play the game Cash Flow. My good friend Michael Zhao from California is going to be facilitating cash flow virtually. And if you've ever played the board game Cash Flow, this is even more fun. This is the board game on steroids, because the way Michael facilitates the game is just, it's a lot of fun. It really gives you the ability to think through strategy, life expectations, what you want to accomplish, where you want to go, and how you're going to get there. So I'd like you to, I really want you to get registered for the event. I actually have an early bird special that'll give you 60% off of VIP Plus. It's only good for the next few days. So if you go to multifamily22.com, plug in early bird 22 in the coupon code, you're going to get 60% off and be able to join us at the event. So I want as many people to get to this event this year as we possibly can. And because we're going to just pour into you for 3 days. So whether you're a novice investor, whether you're a seasoned investor, it makes no difference. If you're a seasoned investor, you're just going to get that great shot in the arm. If you're a novice investor, it's going to help you walk away knowing, man, I can go do this business. And, we, like I talked about building a schedule, we can build a plan. We can build a plan to build our business. But if we don't execute on that plan, we really don't have much of a plan. So one of the questions that somebody had emailed me over the last couple of weeks is, how do you get started in multifamily real estate? Well, I'll tell you a little bit about my story, how I got started. I had a construction company. I did a lot of work for a couple of Chicago area syndicators over the years. And I always had this passion, this idea I wanted to go in the business. I understood the business. And this is the part of it I understood, that you could raise private capital from individuals, that you could marry that capital with a great real estate deal, stay in the middle, and everybody'd make money. And I always knew that process. That goes back to a long, when I first got involved in the real estate investing space, I studied with a trainer by the name of Robert Allen. And Robert Allen was known for no money down, for OPM, other people's money, and doing creative financing deals. And so when I looked at that strategy along with the syndication model, the two really marry each other really well. Robert Allen, though, that was a great story, right? He put this big claim out there, put me in any city in the country. I will take my wallet, take my money, and by the end of 3 days, I'll own real estate and have money back in my wallet. Got, the St. Louis Times took him up on that offer, dropped him in the middle of St. Louis on a Friday afternoon, took his wallet, left him $20. By the end of the weekend, I think he had 4 real estate deals under contract, cash in his pocket, said he stayed in the finest hotel the night before. So, it's about how we structure and control. It's all in real estate. It's all about controlling the transaction, controlling the asset. And that's how we get started in it. So anyhow, I was in the construction business and I was, doing a lot of work for a couple of local syndicators. I really had a fever for the business. I went into residential sales. And for the next 12 years in residential sales, I sold, my first year, I sold 78 houses. Beyond that, built a team and sold over 100 houses a year, pretty consecutively for 12 years. 2005, I went into the apartment business. And like I said, I didn't just make a decision one morning to get up, but I thought about it for a long time. I understood the economies of scale. I understood that if I had a vacancy, I could probably still pay my rent because there were other people living in that building. I understood that my expenses would be less. I understood that I had less repairs, less maintenance issues, taxes were less as a result of the economies of scale. And that's why multifamily is such an important asset class over single family. So I came from a fix and flip world as an investor. I came from a real estate sales background. and went into the multifamily business. And I just took action is what I did. So, when you look at getting started, I think everybody's journey becomes different. I just spent the last couple of days with a good friend of mine who's been in the apartment business for 25 years. He went to work for an apartment syndicator in Southern California years ago. They did close to $1 billion in assets in 7 years. He and I have become really good friends over the years. And, we spent this time together. He's involved in a company today that in the last 5 years, they've done $1 billion in assets. But they started from nothing. He didn't know much when he went into the business. He had a little bit of a finance background, understood how the numbers worked, and really had a passion for real estate, really had a passion for multifamily. So I would ask you back, in getting started, what's your passion? Where does that lie? What do you want to accomplish? So, one thing that I always do is I like to ask a lot of questions back, because I think that we challenge ourselves by asking more questions. So I would read a great book. There's a number of great books out there. I read a book years ago by Gary Keller called The Millionaire Real Estate Investor, which I think today is still one of the best books out there, because it talks about the investing principles in real estate, not just multifamily, but real estate. To get started, though, we have to take action. We have to take the next step. A lot of us sit around and say, wow, I'd like to do this, or I should be doing this, or what if I did this? But we don't take action. So the next step is take some action. Find yourself a great team of other people. Find out what you're really good at. I have a great team around me right now. And the only reason they're a great team is because we have all decided all of the moving parts or the spinning plates that go into a multifamily purchase, syndication, where we involve a syndication is nothing more than just involving a number of people in a purchase of an apartment complex. And that team, we decided these are all the things that need to happen. Everything from finding a deal, underwriting a deal, analyzing it, doing the inspections and the due diligence, financing it, doing the insurance work around it, then, closing that deal, raising capital on the syndication side, and then the operations, the asset management piece of it. Find out what you're really good at. Take advantage of that. Move forward in that space. So when you get started, get the education you need, but take action on the education. I believe a lot of times people get overeducated, and that education doesn't give them the ability to move forward because they overanalyze. You can't overanalyze. You have to take action, take the next step. One of the next questions I got was, what market trends affect multifamily investing today? Well, I think we're looking at it right now. There's no doubt that the markets that we're headed into, that we're in, the markets changed back in March and April of this year as the Fed started to raise interest rates to slow down the economy. It started to change the markets. The Fed's raised rates. So, the lenders have to raise rates also. So now what's happening is that we have interest rates that have gone up. Pricing on property is still where it's been, although sellers are starting to realize that they're going to have to reduce their price, that cap rates are going to need to decompress a little bit in order for the market to continue to move forward. Some of the other trends have been, we just came out of the 2 years of the pandemic, right? And the supply chain constraints and the ability to get product, businesses that have struggled as a result of it. All of these things have played a part into the economy and where pricing is. The other thing that is affecting real estate right now are rents. You have to watch the market that you're in. You have to watch your product class and the product that you own on how to raise rents. we've seen the last couple of years where we've had very aggressive rent rates, very aggressive rent growth. And I believe we're going to start to see a slowdown in that rent growth. If you look at some of the analytics that are being put out right now by some of the companies like CoStar and Axiom and Real Trends, you're going to start to see that the aggressive pricing in rents that we had seen has slowed down a little bit. I remember a year ago analyzing properties in the Florida market and seeing that the rents were going to grow maybe 20, 22%, 23% over the course of the next year. Well, those have backed off. Those numbers have backed way off, and we're seeing a lot lower trends now. So when you analyze a property today or you underwrite it, right? Underwriting is just that fancy word for taking all of the current financials that a seller have and putting it into a spreadsheet or into a tool to see how that property operates and how that property runs, especially under stress. You can put in the different rent growth that you want, the different expense growth that you want. Put a stress test on that analyzation to see how the property is going to perform for that syndication, for that offering. Sometimes they make sense, sometimes they don't. Another question I got from an investor was, how do you assess the risk? And that kind of leads right into the question I just asked about evaluating the markets, evaluating the property. We assess the risk by saying, what if? I'm a big what if guy. I want to ask that question a lot because I want to know, what if the rents don't go up as much as projected? A seller may provide in an offering memorandum for you that pro forma. This is what the broker and the seller think the performance of that property is going to be moving forward in the next 12 to 24 months. But what if that doesn't happen? What if interest rates go up a little bit more before you close on that property? How do you handle that? A good way to handle that will be to retrade the deal with the seller, right? To go back and talk about another price reduction before closing on a property. Don't ever be afraid as we move more into a buyer's market right now to go back and ask that seller for more of a discount or something different on that property because it doesn't perform at the originally anticipated interest rate, rent growth, loan to value. Those are things that we need to look at. How about an exit cap rate? An exit cap rate is just as important as your going in cap rate. You have to look at that and really kind of, it's throwing a dart at a dartboard, right? And saying that I believe that if I buy this property today at X, that I think that that we're going to see a decompression in cap rates and that cap rates will go up for 15 to 25 basis points per year over the next several years, that we're going to hold that asset. Well, if you bake that into your return analysis and then you have some rent growth and expense growth and some reduction in loss to lease, you can see how you can start to stabilize that property over time. This goes back to building exit plan, right? We all need to build an exit plan into our property acquisitions before we close on that property. I wrote the book Exit Plan. I wrote it because I want people, to understand how to maximize profit, the best places to maximize profit. How do we get into a real estate transaction and pull profit out, along the way? Exiting a real estate transaction or a holding doesn't necessarily mean that you're just selling it out, getting out of it. But what it does mean is that somewhere along the line, you're maybe refinancing, bringing a partner in, recapitalizing that property so that you can take advantage and maximize the profit. Another question that people ask a lot is, how do we find deals? Well, I always believe that there's different sources for finding, locating, sourcing great deals. There's, if you were a listing agent in the real estate business, how do you go find listings? Well, we reach out to sellers. We find properties that are on the market. There's direct mailing programs. There are, dialing for dollars, driving for dollars. You can go and knock on doors. The best ways that I have found to find real estate deals, first of all, build great relationships with brokers. Brokers control 80% of the market. And by building great relationships and being a sponsor, being a buyer that can actually execute and can come to the table and close a deal, that's what brokers are looking for. But if you build great relationships in the markets that you want to be buying property in, you will be able to get a great source of properties coming across your desk. It's about supply and demand. The more you look at, the more you analyze, the more opportunity that arises for you. So when I build relationships with brokers, it's not just one brokerage. There's the 5 major brokerages in the marketplace. Might be CBRE, Marcus Millichap, Colliers, Berkadia, Walker Dunlop, depending on the market you're in. And then there's always the boutique brokers. And those brokers you build relationships with also, like in the Florida market. Franklin Street is a great boutique broker. And we build relationships with these agents that have the multifamily deals. Ask for referrals. If you're buying a property from a seller, ask the seller who else they know who might be looking to sell. One of the great strategies that I like, especially in the small multifamily space, is I like to go to the tax assessor's office, the county assessor's office, pull a list of properties that are 2 to 4 units or 4 to 20 units or 20 to 50 units in a particular submarket, and then start to call those sellers and ask them when they want to sell. And you can do this in any asset class. It's not just residential. It's not just multifamily. It could be in senior housing. It could be in self-storage. It could be in office or retail, whatever you're attracted to as an investor. But that's how we find deals. I think the best way to find great deals is really what the question is we just look at enough of them. The more property you look at, the more properties you analyze, the better opportunity for deals that arise and exist. So this is the best way, because then you can you also understand those market trends. You understand what other properties are selling for, what other properties are priced for. You understand rent growth in other properties in your competition. And by understanding a market to its fullest, helps you find those best deals in that market. Now, part of this becomes the market itself. How do we look at a market? You might be an investor like myself that doesn't invest in their own backyard. I live in Chicago. I don't spend a lot of time investing in Chicago, although there are some good opportunities here. I just like to be in places where some of the trends are more robust. I like to be more in states that are investor friendly, landlord friendly, that give more opportunity to the landlord. I'm not saying that we're taking away opportunity from the tenant, because we still have fair housing guidelines we need to abide by. We still have to, supply good housing to tenants. One of my missions has always been to supply safe and secure housing for my residents. So how do we find those markets though? Well, there's a number of traps, and that's what I tend to call them, are the traps, but they are population growth. Where are people moving to, and why are they moving there, more importantly? So if you have people moving to markets like the Carolinas or Florida or Arizona or Texas. Why are they going there? They're going there because quality of lifestyle, longer summer times, better weather, and better property pricing, lower taxes, things like that. So population growth is the first metric or trend that we look at. Here's what happens next. Because population growth grows, job growth grows. So we see new businesses open up. We see service businesses, restaurants that have to add staff because now they have more people that are there spending money. Then household income is the third thing. Because new jobs open up, household income opens up also. And as household income grows, that gives us the ability to raise rents. And we want to be able to raise rents. That's why we're taking over a property. So, when we go in and we do capital improvements on property is one thing. That's forced appreciation. But we also have to have that organic growth in that market also. And that organic growth happens as a result of population, job, and household income growth. Then there's a number of other fundamentals that we look at. If you have an interest in those, you want to know more about those, call me, send me an email. I can give you a complete list of what to look at and how those work in the different markets. When I look at markets today, though, if you looked on a map, I will look from markets that are the Dallas, Fort Worth, Houston, Texas markets, all the way up to Charlotte, North Carolina, in that southeast corridor of the U.S. Again, better lifestyle, longer, better weather seasons, less taxes, more landlord friendly, more to the advantage of the developer, more to the advantage of the sponsor. That's what gives us those better trends in those markets. Another question that I got here is, what type of multifamily will you buy? I think that's a great question. People ask, well, what do I look for? What type of multifamily should I buy? Well, you have to build a buying box. You have to build that box that says, hey, when I pull into a parking lot of an apartment complex or a small multifamily building, do I see what I want to buy? Is it appealing to the eye? Because if it's appealing to my eye, it's going to be appealing to somebody else's. There's a lot of different classifications. Apartments are classified A, B, C, and D. Well, what do those mean? And why does that work? I've always been a B-class property buyer. It's workforce housing. It's market rate rent. I don't typically buy affordable housing. I don't typically buy product that is tax credit, but I buy marketplace rent, workforce housing, because when the markets change, like we're shifting into now, those units tend to stay rented for longer periods of time than your A-class properties, which are higher end properties, and your C-class properties. That market rate rent tends to perform better for the investor, for the syndication model. I like garden style buildings, 2 to 3 story unit buildings. Now, I'm not saying that a small mid-sized building, a 4-story building in some markets doesn't make sense. I'm not a big flat roof buyer. That's why I like the garden style, because they come more pitched roofs. But flat roofs, mid-story buildings in some markets, like a St. Petersburg, Florida, are better types of product to buy in that market, just because the trends for people to live in those are stronger than in other product classes. So know the market you're going into. Spend the time to do the research, read the articles, read the data, take a look at what makes sense in those markets. The other thing I look for is a minimum of 1.5 parking spots per unit. I like a minimum of 60% 2 to 3 bedroom properties, 2 to 3 bedroom units in my properties. I'm not a real big single bedroom or studio buyer. And the reason for that is because I think a lot of people think the way I think. So what they tend to do is look stronger for the 2 to 3 bedroom properties. They sell quicker on your resale, but they also rent better. Now, also understand the market again. So there are the times that 1 bedroom and studios make more sense. If you're in a South Dakota market, in the oil fields, where you have a lot of workers that rent an apartment, you're going to find more of those oil field workers rent more 1 bedroom and studio apartments than double up with each other. So there are the markets to take a look at where it makes more sense to buy those smaller units. All right, I have time for one more question here. This is a great question. As an investor, how do I assess risk? Well, I think that everybody has their own risk tolerance. As an investor, you need to assess, first of all, your own risk tolerance. What are you willing to risk? What are you willing not to risk? Years ago, I had a very high risk tolerance. There were a lot of things that I didn't really pay a lot of attention to or look at in the fundamentals because my risk tolerance personally was a lot higher. And I always of the opinion, if you throw enough against the wall, something will stick. Well, that doesn't always work in every market or every type of risk tolerance. Today, I'm more in tune to assessing that risk. I want to look at purchase price, taxes, rent growth. We look at those cap rates. We make sure that we provide enough DCSR, debt service coverage ratio, for the bank on the lending side. If some of these terms are unfamiliar to you, here you can go and download. I have a whole course on language that's a free download. You could go to, if you have an interest, I can't think of the link offhand, but if you have an interest, let me know. I'll send you the link for it so that you can grab this download and listen to this language course. If some of these terms that I've used are maybe out of box for you today, but you have to look at risk calculated, right? Look at the market, look at the numbers. A friend of mine told me a long time ago, he said, the math never lies. And if we look at those trends and we look at the math, we can make smart decisions, wise choices, decisions and choices that will help us put together a good syndication on an apartment complex and grow it for our investors. So our investors see a great return so that you take advantage of a great return. Hey, I want to thank everybody for being here this morning. We had a number of people on. It was good to see people from all over that were listening in. So thank you for that. If you have other questions, if there's things I can answer for you, don't hesitate to reach out. Shoot me an email at mike@mycoreintentions.com. If you want to, I love to network. So, if you just want to network a little bit, you can reach out and we can do that as well. If you're a passive investor, you're looking for opportunity. There is a ton of opportunity. I've had people say, do I just sit on the sidelines right now with the changing fundamentals in the market? And I always use this story, right? I say, listen, there's 2 times we can plant a tree. Well, the first time is 20 years ago or today. Either way, that tree's going to grow, right? So you can get ahead of the next bull market by getting started today. Don't sit on the sidelines. There's great opportunity out there. I know my team and I are evaluating real estate offerings every day to find that next great syndication that we're going to acquire and bring to the market. If you're a passive investor looking for a way to offset inflation today, to take advantage of this market, to grow in this market, and as we go into a new cycle again, remember, there's always 4 seasons: spring, summer, winter, and fall, right? Those 4 seasons run the same in the real estate market. So right now we're in that fall season. maybe in the start of winter. Don't wait. Get involved. I have found over 30 years of being in this business that the best time to get involved in real estate investing is today, because no matter the cycle, no matter the time, there's great opportunity out there. And frankly, I've never seen a better time in history to buy real estate than right now. Hey, thanks everybody for being here. Remember, if you want more information, more knowledge, I have my multifamily summit coming up October 20th through the 22nd, a 3-day virtual event, over 20 speakers on the main stage, 3 panels, breakout rooms, networking. It's going to be 3 days of intense pouring into you, helping you learn, helping you grow, helping you get started. Come out, find some team members, find some people that are going to help your business. Here's the great news about the virtual side of this also. If you can't make the whole event, it's going to be recorded. You'll get a link to that. You'll be able to go back and listen to it. I have an early bird special going on right now that my team is super excited about. 60% off of VIP Plus sponsorship or as VIP tickets. You can go to multifamily22.com, put in the coupon code earlybird22, get 60% off of VIP Plus tickets. You're going to get access to everything, all the speakers, cash flow, the networking, all the events that we have going on for that 3-day virtual event. Plus, you're going to get access to the big announcements that we're going to have towards the end of the 3-day event. So you're going to want to make sure that you're there for this event. It's going to be a great event. I have some great speakers that are going to be speaking this year. Bronson Hill is going to talk to us about how to raise $12 million in private capital in the next 12 months. We're going to have Patrick Grimes, who's going to talk about market conditions and what we see in the market today. We're going to talk about Cody Laughlin and Brian Alfaro are going to talk about the trends that have happened in Q1 and Q2 of this year. Karen Hall is going to talk about how to passively invest using your self-directed IRA. So the list goes on. And if I haven't mentioned you, I apologize for that. Just remember, you are well appreciated for taking the time. Make sure you're at the event, multifamily22.com. We'll be back here next week with another great speaker, great guest. Love that you're here. If I can answer questions, don't hesitate to reach out. I look forward to seeing everybody throughout the week. Take care, everybody. Have a good week.